Hello, this is Caleb Barney with Russell Real Estate, and today I want to go over a Housing Wire article titled Data Digest Excess Inventory and the Return of the Wall Street SFR Players. So, SFR in this case means single family rentals, and basically, in 2021, 2022, there were a lot of big time Wall Street players that were buying properties and turning them into rental properties. Well, as interest rates progressed and got higher and higher, as the year went on in 2022, not a lot of people were selling their houses, so inventory or supply went way down, and that's what James Kleiman, the article or the author of this article, notes here. He said large single family rental investors didn't have much of an appetite in the fourth quarter of 2022 and the first quarter of 2023. Or perhaps I should say that they didn't have much food to choose from. So, once again, sure, they didn't buy much in the fourth quarter of 2022 or Q1 of 2023, but that's because there really wasn't much out there. So, what they are actually doing now is they're actually partnering up with builders and creating their own inventory, essentially. So it says these single family rental investors are targeting the $300,000 to $500,000 price point, and and they've been increasing their home purchases since March. So one of those big headlines is Pretium Partners. They had a $1.5 billion purchase of 4,000 build for rent homes concentrated in the South and Southwest. So they are buying up these build for rent homes, basically houses that were built up as new construction specifically with renting in mind. And they aren't the only, Wall Street firm that are doing that. So we're basically seeing more and more of that. And it says a rise in volume of homes available for sale in certain areas is already happening. So they're expecting these single family rental firms to swoop in and basically take over that excess inventory. Again, most of the excess inventory right now is not where I'm located, which is in Northeast Ohio. We still have an inventory issue where supply is very, very low. And if there's anything in that $300,000 to $500,000 range, honestly, once we start creeping up to the 4 and 5, it does start to slow down a little bit. But 300,000 and under, especially, it can't stay on the market long enough. It's basically there for 7 days or less. And especially if you're at that entry level buyer, there's nothing out there. So you typically see a house listed on a Thursday or Friday, get under contract by Monday, where I'm at, which is just south of Cleveland. So basically, they say that for now, institutional investors only control about 3 to 5% of the single family rental market, but they are making inroads, and that sector has grown about 20% in the last 3 or 4 years. So this is why I think it's actually more important, if you are a renter right now, to really do whatever you can to save up and get into home ownership, because I see this basically just becoming more and more of an issue. These institutional investors, I imagine they're being smart about where they're buying. So, for example, those 4,000 build for rent homes, they're going to be spread out. They just say generically in the South and Southwest. But if you buy 4,000 homes in one market, you do get to control or dictate the pricing. But at the same time, if there's so much competition and there are all of these rentals available, at a certain point, the rent prices are going to actually start going down. So I think that they'll be smart about how much they buy and how much they build, just because they don't want to essentially slash their own throat by providing too much rental inventory in the market, and that gives people more and more options, and they can basically have a lower rent price, than being charged a premium. So that's what we're looking at here. It does say that they have the top 10 metros for build to rent completions in 2022. Ohio is not on that on that list. You do see that basically 8 out of the 10 are at 10-year highs for single family rental units completed, and I'm actually a little surprised that that's not higher. I figured almost all of them would be at the 10-year high, just because I didn't really think that this was that big of a market previously. So of course it's easier for you to be at your all-time high or near it then. One other item of note that I did want to go over here is new construction homes now represent more than 1/3 of the sales market overall, which is far higher than historical norms. And again, that makes sense because of where interest rates have been. There's actually a stat in here, if I can find it. He says 62% of mortgage borrowers have a rate under 4%. I thought I saw some stat saying that like 20% of all homeowners don't have a mortgage at all. So if you have 62% of the people with a mortgage having an interest rate under 4%, and another 20% of all homeowners not having a mortgage at all, like having their home paid for free and clear, it really disincentivizes those borrowers to go out and buy a home with the current interest rates, which when I looked at Mortgage News Daily earlier today, it was sitting at, I think the national average for the 30-year fixed rate was at like 6.9. So it really disincentivizes a lot of those homeowners to actually sell their house at a 4% interest rate and move up in price, more than likely, as their interest rate's going to be closer to 7%, 6.5% to 7%. So that is why inventory is very low right now, and that's why existing homes inventory is very low, and that's why I think more and more people are turning to just buying new construction, way more than they have historically speaking. So that's just my 2 cents on some of this. I thought it was just interesting to see that Wall Street is jumping in back into the game, and I actually thought I saw something. Was it Blackstone? They were looking to invest some crazy amount of money, and an article just came out recently about that as well. So Wall Street is back at it as far as buying single-family properties. If they're doing it, for the money, I think that it would be wise of us, little fish basically, to try to do the same thing and try to get in or as soon as we can, because it does take these big institutional buyers a long time sometimes to get rolling. So try to get in while you can. Otherwise, I think housing affordability isn't going to be helped by Wall Street buying houses. Let's just put it that way. If you have any questions, let me know, especially about the Northeast Ohio market. I'd be more than happy to chat. Otherwise, have a great day.